it's Greg Schnell, and I am here with Martin Prings for Martin's monthly market roundup for the end of March 2019. It has been a wild quarter, Martin. Everything has gone straight up. It's been almost ballistic, and we have lots of charts to go through, I'm pretty sure, because when I go through my charts every week, I know I'm always finding things that surprise me. I'm extremely interested to see what your presentation has got. How are you doing?
I'm doing fine, Greg. How are you? Thank you.
Really good, thank you. Martin, of course, one of the things that I always like about the way it works when you and I get together is I've used all of my charts to kind of come up with an opinion. You've used all of your charts, and it's interesting when they either complement each other or don't. And I know as we come off this market low, Arthur Hill has started to turn bullish, and I haven't. I was bullish, and now I've kind of receded into the background. So I'm anxious to see what you've got. Why don't I let you start rolling through the charts, and then we'll, if I see something that's interesting, I can speak up.
Yeah, please interrupt me at any time you want to, because we want to make sure that this is we're getting our message across.
Okay, sounds good.
So the areas to be covered this month are, first of all, there's some green shoots that hint at the economic slowdown, which has been going on, the growth slowdown, which has been going on since basically last summer, may be over. I'm not saying it is over, I'm saying there's some green shoots that point in that direction. And that's the first positive sign I've seen in many months. Also, I have a model which I call the stop barometer, which I take back to the 1950s. And it went bullish at the end of March. So we'll take a look at that. And in the last presentation, last couple of presentations really, we looked at the battle between inflationary and deflationary forces in the financial markets, and pointing out that it was fairly evenly balanced, but the basic trend is moving in favor of deflation-sensitive assets rather than inflation-sensitive assets. If we see an end to the slowdown, usually commodity prices will decline during a slowdown. If we're going to see an end to the slowdown, then that would reverse that process. Also, a really interesting chart I got is the Shanghai composite, which we talked about last month, I think. But it looks to me like it might be about to break above a multi-year rate of change downtrend line. And when I talk about multi-year, I'm talking about a decade or more. And when that happens, usually you get a significant reversal in the direction of the breakout. So that's what we look at too. And then finally, last month we got bonds breaking to the upside, which we thought was probably going to happen. And the dollar, which we weren't really covering last month because we felt that it was too close to call in many respects. It looks like the dollar is headed towards breaking out on the upside, but we'll look at that a little bit later. So I'm going to start off with talking about the economy. I mean, the first slide I've got here is the one with the chemical activity barometer. This is a composite leading economic indicator put out by the American Chemistry Council. And it's kind of unique because it goes back to, I think it's 1912, maybe it's 1920. It's a long way it goes back. And I love to look at long-term charts and long-term relationships, because the longer you can go back, generally speaking, the more differing conditions you can follow, and therefore you can get some fairly reliable indicators from that. It says chemical activity barometer, but it includes a lot of other economic indicators apart from what goes on in the chemistry industry. But it's unique because it uses these chemical shipments and so forth, and none of the other leading indicators include that, and it's been proven to lead recessions, every recession, between 2 months and 14 months. I think the average is 7. So anyway, that's a little bit of background on the indicator. What this chart is really trying to tell us is that there are two kinds of economic condition apart from recovery. One is a recession, which we've got in red highlight here, and the other is a slowdown, where the growth part of the economy slows down. And you can see this, for example, just here, where we define a slowdown as when the KST peaks, comes down, and then starts to rally before it goes below zero, like it does here, which is signaling a recession. So every time it's gone below zero, we've had a recession. And every time it's rallied above zero, it's fallen and rallied above zero, we've had a slowdown. So the vertical lines here represent the end of a recession in red and the end of a slowdown in beige. And as you can see, we've been in a slowdown condition since the middle of last year, and it's still moving lower. Now, what we don't know is whether or not this is going to extend and turn into a recession, or whether it was going to reverse from above zero and result in the third slowdown since the recovery began. So we have a couple of indicators. What was that, Greg?
The one thing I was going to say is you didn't draw a trend line on your long-term KST there. Have you found they just don't help, or it's just too...
Sometimes they do, and sometimes they don't. I didn't draw it there because that wasn't really what I was trying to get across. But what you're suggesting is if we draw a trend line from here to here, it's probably been violated, right?
Yeah, and in the 95 through 98 period there, you'd have a trend line that kind of started your 2000 slowdown.
I mean, if you take this period here, for example, you could draw a line from here to here and it got violated, and then it went down, but then it reversed again.
Yeah.
So I tend not to do that unless I've got other backing evidence that's supporting me. But the point I'm making is that during this recovery, we've been able to extend the recovery largely because we've experienced a couple of slowdowns, which are kind of cathartic experience as the economy recovers, and that's enabled the recovery to. One of the reasons why the recovery is extended, because it's kind of like a pit stop in a car race. If you can stop and refuel and change your tires and everything, that gives you the platform to then continue the race. Well, the same thing is true of these growth slowdowns. They're cathartic, as I said, a cathartic experience, which allows the economy to then resurge. One of the things in that ended both of these slowdowns, as I recall, was that we had some quantitative easing, so the Fed sort of came in. Now, if you look at the current situation, we've got the Fed is no longer tightening. Bond yields are coming down, which acts as a sort of a flow of liquidity to the system. And we also had a really large drop in oil prices, which again, I know they're rising right now, but the fall in oil prices also put a lot of purchasing power in people's hands. So there's a couple of reasons why this slowdown might end. So a lot of people have been talking about the yield curve, and that's the subject of the next slide. So here we have a yield curve where we compare the 10-year to the 1-year, and when it inverts, that's where we get this red line here. And red highlights once again represent recessions. And I mentioned that the yield curve has become very popular. I've never seen it so popular as an indicator before. And usually when an indicator becomes very popular, its message is already factored into the market. And the message here, of course, is that the yield curve is inverted, therefore we're going to have a recession. And I see many articles and people writing about that. And this chart certainly supports that idea, except that there's a couple of things that need to happen before you get to a recessionary stage. One is that the yield curve inverts. So every time it inverts, like it goes below or touches the red line here, indicating that money is getting tighter. After a while, we move into a recession in all these situations here. So that's the first thing that happens. The second thing that happens is that usually you don't get into a recessionary phase until the yield curve starts to steepen again, move back in the opposite direction, which is indicative of a weakening economy. And so is this indicator in the bottom panel here. This is we have an indicator I calculated called the Pring leading economic indicator, and it's in its raw state. It includes 4 different sectors of the economy: housing, the stock market, consumer spending, and the employment trends indicator put out by the conference board. This indicator you're seeing here is a momentum indicator of the actual raw data. And the idea, we call it a recession caller, is when it crosses below zero or approaches zero. Usually it's a crossing here. You look up the end at the top of this red line, that's when a recession begins. There it crosses again, that's where a recession begins. Crosses again, there's another recession. Crosses again, another recession. So in other words, when you have an inverted yield curve, you want to see two things happening. One is, first of all, the curve inverts. And second of all, that's translating into the economy itself with a sell signal on this recession caller. And at the present time, and you can see that during, if you remember from the previous chart, this whole period here where it's going sideways was one where there was a recovery and then there was a slowdown and a recovery and a slowdown. At no point during that period did it look like it was crossing below zero. It sort of held way above the red recession, not zero, I'm sorry, the red recession caller, because that's a little bit below zero. So right now it's in a declining trend, and it wouldn't take much to put it into recession and confirm what the yield curve is saying. But on the other hand, it's not given us that signal yet. So we can't say that a recession is at hand when we haven't had one signal. But a funny thing has been happening on the way to this recession. And next two charts, this one and the next one, are going to kind of demonstrate why we may not be entering recession, and the slowdown may be about to end. The top panel, we got housing starts, and underneath, and the red and beige areas represent the recessions and slowdowns again. But underneath is my leading housing indicator, and it's the KST of the leading housing indicator, and when it turns up, typically what's going to happen is housing starts are going to move higher. And when housing starts are the most leading of all economic indicators, apart from financial leading indicators. And so that is obviously bullish down the road for the economy, maybe not for the rest of the economy. It'll show up in the other indicators, but a little bit down the road rather than at the time when we get the reversal, because housing is typically has such a long lead. But if you look at the number of times, every time we get one of these green vertical lines, what happens if you look at the top to the right is that housing starts continue to expand. Having said that, there are two periods when they didn't. One was, and that was a really bad call here in 1973 by this dashed red line here, and then another one during the housing crisis of 2007, 2008. So it doesn't guarantee that housing starts are going to pick up when the leading indicator for housing starts to turn up, but it certainly puts the odds in your favor. Another indicator I'm looking at too, so it's kind of an initial sign, green shoot sign. Maybe we're not going into recession. Maybe we're going into a renewed period of growth again. So here's another indicator. This is the ECRI weekly leading economic indicator. If you Google ECRI business, you'll be able to get to their site where they publish this indicator every week with a 1 week lag. If you subscribe to their service, you get the up-to-date data, but it's on a complimentary basis. It's delayed by a week. So what we have underneath is a price oscillator where we divide a 3 months by a 24-month moving average. And when this indicator bottoms out, typically what you're going to see is that the economy is also going to bottom out, the economy in terms of the weekly leading economic indicator. Once again, we got the red indicating recessions and the beige indicating slowdowns. And you can see sometimes a slowdown, all it means is a slowdown in the growth rate rather than natural contraction, because the leading economic indicator was still moving up. So one of the reasons I'm looking at this chart is that I'm looking at these vertical lines, which show, this time they're showing the end of the recession and the end of the slowdown. And you can see that the price oscillator typically is going to turn up ahead of the end of the slowdown. So that's a leading indicator that tells you we may be moving out of the slowdown. Well, what happened last month was it started to tick up. You can see, I didn't put an arrow here, but we could have put an arrow here for that recession. Sometimes it's coincident, and sometimes you get a full signal. And that's why I'm not banking I'm not betting the mortgage on either of the two signals I've shown you, because they're not 100% accurate, but they are very high probability accurate. And if we were looking for a way out of the recession, that's kind of where we would look. And also, the fact the stock market's been able to rebound as much as it has, and sentiment has rebounded as well. Like, for example, Michigan consumer sentiment is very close. We're at 1.5 or so of its cyclical high, which I think was about 100, and it's in 98.5 or something like that. So that's a big rebound in confidence, and consumer confidence is something which leads the economy as well. So, zeroing in now on the financial markets, we look here at this, the S&P in the top panel versus my stock barometer. The stock barometer has about 6 different components, different indicators that all work pretty well most of the time, but none of them is perfect. So that's why we combine them up into a consensus indicator. And when it reaches 50%, it goes bullish, and it gives us a green highlight. Well, it went bullish last month, barely, because it was only up to 50%. But also, you notice that the S&P is above this red dashed line here, which is the 12-month moving average. So that's the 12-month moving average tests pretty well better than pretty well all other averages over a lot of different financial markets. It's by no means perfect, obviously. I mean, you get whipsaws here, you get a whipsaw there. But by and large, if you're going to use some kind of moving average as an objective measure, a 12-month span, which of course is seasonally adjusted because it includes all months, is a good place to start. One of the things I noticed is that when the indicator goes bullish, it tends to, after a bearish signal, it tends to mean what it says. There are a couple of whipsaws, like this sell signal here, but after it took place, the market then continued to move on higher. There was a false signal there, but most of the times when you go from bearish to bullish, it means what it says. So here we had you could call that a whipsaw, I guess, because it would have been a losing signal. You would have sold it, you would have bought back at a lower price, a higher price than where you sold it. But that's a pretty good indicator, I think. And I know I forget what the test results were, but since the 1950s, but it's definitely very, very positive. And so that kind of puts the odds. One very important piece of information that the stock market may be tired of going down, and maybe we're going to have some kind of a new bull market here. So one of the indicators that I developed, which I think is very good, or reasonably accurate, is this financial asset velocity. What we're doing is comparing that to inflation-adjusted stock prices, and the red highlights again represent recessions. So the financial asset velocity is a very simple indicator. What it does is it adds up an 18-month rate of change for a measure of stocks, S&P, measure of bonds, 20-year bond prices, and commodities, which would be the CRB spot raw industrials. Add those up together, and that creates this index here. Now, the resulting index, as you can see from the black line, is pretty jagged. So what we do is we run a 6-month moving average, just that thick blue line, and when you go down to 0 or a little bit below 0 or maybe slightly above 0 just here, and the 6-month moving average starts to turn up, that gives us a buy signal. And as you can see, since 1955, 56, every buy signal, except this one here in 1978, was followed by a meaningful rally. I mean, if you look at this signal here, it doesn't look like much of a rally here, but don't forget this is probably about a 6 or 8 month period here, because this chart's covering a tremendous amount of time. But by and large, most of the times you get a really good signal of the market going higher. So the idea here is that when this financial velocity indicator is rising, it indicates that there's enough liquidity going in the system that's consistent with, and it's reflected in the bond market and the commodity markets, and it's sufficient to allow stock prices to go higher. And then when it starts to come to the downside, it's suggesting that liquidity is being drained from the system, because if stocks aren't coming down, then probably bonds and commodities are. And so that has the effect of bringing the overall velocity index down. Well, right now, it's still bearish because the blue line is still declining. But you can see what's happened, and we're getting a rally in bonds. Stocks have been pretty reasonable, so maybe we're going to see a turnaround in that indicator. Right now, you have to say it's bearish. That's what the evidence says, but it wouldn't take much, obviously, to turn this to the upside. So that's why we need to watch what happens to bonds and whether commodities, which are in a bear market now, but not a very serious one or steep one. If that starts to reverse, this is going to start to reverse too.
And Martin, did you find any value in the zero line itself or not?
Well, I'm just using the zero line as kind of equilibrium, and when it reverses from the zero or below zero, that's when I get the signal. I don't usually look at these signals when it reverses from way above zero, because they tend to give you unreliable results.
Okay. I like that chart. What I like about it the most is just you can see that things kind of peak out at the 40 level, 40 to 50, and there's been a few rare exceptions, early 83, 87, and 2010, 11, where it went way above that. But, that 40, 50, 60 just kind of sets the peak of the indicator, if you will, overbought or oversold, but it doesn't mean it's done until it goes back below zero for the most part.
Yeah, I know I was just counting up the number of signals we've had. I think I counted 15, and only one of them was the fail with this one just here.
Yeah, and that, like you say, that was still a 6-month rally or something. Yeah. So.
Yeah. So I like its accuracy. So it's still bearish right now. But it wouldn't take much to turn it.
Cool.
Let's see where we go from here. There we go. Okay, not this slide here, but the next slide I'm going to be showing you a schematic diagram where all the sectors are in terms of their long-term KST. I just want to point out a couple of things before I get there. This is the chart of the S&P. This is the long-term KST. When the long-term KST reverses from below zero, that's when we get one of these thick arrows here, indicating that you're oversold and you have the potential to have a nice bull market follow. It doesn't always work out as well as this. And then the thin green lines are where the KST reverses from above zero. And when it does that, we still get a rally, but it's generally speaking not such a strong rally as with the below zero upside reversals. So the next diagram is going to kind of show you where all the sectors are, where the stock market is, and so forth, relative to the KST. So right now, the S&P is above zero and declining. And ideally, in a market bottom, we want to see a lot of all the sectors, well, not all of them, they never all agree that well, but vast majority of sectors down here, either emerging from a decline in their momentum or just going through the last phases of their downside momentum. So that's what we're going to try and do on the next chart. So let me just flip over to that one. So this line here represents the theoretical KST. And remember I mentioned that the S&P was above zero and declining. So that's where that is. We've got the charts, and this is where bonds are, right in the early phase. It doesn't say the bonds are going to go all the way up to there. It just tells you the bonds are in a bullish position now, and until they start to turn over, which they could from below zero or above zero or whatever, as long as they're rising, that's a positive momentum trend. It's only when it starts to turn down that we begin to get worried. So as I said before, the S&P right now is up here, and we have two kind of colors here. One is for approximate early cycle leaders, interest sensitive, defensive stocks, and so forth. And on the right-hand side are late cycle leaders, things like resource-based stocks and semiconductors, industrials, and so forth. And so right now, these are what I would call the attractive groups, because these all are experiencing KSTs below zero and starting to rally, or above zero in rallying, like the electric utilities or the utilities and the REITs. So you got utilities, REITs, staples, telecom, gold shares, all looking pretty good. And then some other stocks continuing to deteriorate here, like home builders are usually a leading group, and they're in a different position right now. But of course, it doesn't mean to say that the home builders have to go all the way down here before they start to go up. We could get a situation where where the curve flattens out and then starts to turn up. But generally speaking, we don't want to see a lot of groups in these areas here. We want to see them all the way down here where they can provide a solid foundation for a rally. So the fact that we've got the early cycle leaders is a good sign, because it indicates that these are groups that tend to do well when commodity prices are falling and deflationary forces are stronger, especially bonds, of course. So it's at quite an interesting juncture where you've got a lot of interesting stocks like gold shares also down here. And you've got a lot on the left-hand part at the top there around the S&P. And a lot of these up here have quite a high weighting, like technology has a high weighting in the S&P, healthcare, financials, and so forth. So it seems to me that what would be a good outcome would be to have a correction here where we test the December lows. And that would allow all of these groups here to start moving down into this buying, what you might call buying territory down the bottom here. So that's what I'm hoping would happen. But you should never use the word hope in when you're investing, of course. So anything about that diagram that strikes you, Greg?
Well, I'm particularly interested in industrial commodities being way down there, and gold. And I think there was a failed breakout on gold this week, which looks to me like it wants to break right down here. So it was a big outside bearish engulfing bar this week, or an outside reversal bar. So not happy with gold at all. And the industrial commodities, copper just seems to be stuck under this $3 level, which is a long-term resistance level. So I'm quite interested just to look on those and see what's going on. And when I rolled through just so many different charts to try and get a feel for what was going on, I just didn't get any pop in the industrial commodities yet. So I'm very puzzled to see if they can break out to the upside and start building this base to go from. And I keep thinking it's Shanghai related. So as we've talked about, the Shanghai seems to be trying to turn higher. So I'm interested to see how this all works out. But the financials make up a huge component. Technology started to underperform this week. So I'm very interested to see where this all goes. But I agree with you that the positioning of everything seems too high on the left, and it probably needs a pullback to kind of finish the bottoming process.
Yeah, one of the other points I didn't make before is that during a recession, I've always thought of gold shares and gold as an inflation hedge. But typically in a recession, I think 5 of the last recessions, gold prices actually went up during the course of the recession. And on those remaining 2, it kind of went slightly down, almost sideways to slightly down. So having gold down here right now is kind of indicative of a weak economy, which is consistent. So last chart before I move over to the stock charts platform is this dollar index. And you can see it's been trading between its 200-day moving average here and this green resistance trend line. And it looked a couple of weeks ago as if it was on the verge of breaking to the downside. Now it looks like it's on the verge of breaking to the upside, which of course wouldn't be a positive back sign for gold. It doesn't say gold can't go up when the dollar is going up, but gold much prefers the dollar going down than going up. And the other indicator here is the my cumulative net new high dollar index, where I calculate a lot of cross dollar relationships on a 40-day time span. In other words, if it makes a new high on over a 40-day span, that gets in the plus column. If it makes a new low over 40 days, goes in the minus column. And then we take accumulation of that difference. And when you can draw a trend line on this cumulative line, it tends to mean what it says. And also when it crosses below its 200-day moving average, as it did here, for a sell signal. So it's given a couple of really interesting signals, both over here a sell signal and over here a buy signal. And again, one of the great things about the fact that a moving average and a trend line are in the same area gives you a lot more confidence that when they're violated, you're actually running through two important levels of resistance, one flagged by the trend line, one by the moving average. And that was a beautiful signal just there. So fast forward to where we are now. A few weeks ago, just when it started to look like the dollar index was going to drop below this 200-day moving average, and you could draw a support trend line here. It didn't and rallied. Well, the same thing happened to the cumulative net new high. It looked like it was forming a head and shoulders, but now it's rallied back above the line, joining the head with the right shoulder, which indicates that the odds favor that head and shoulders pattern failing. And even the dollar diffusion index, which measures the a number of cross-dollar relationships which are above their 40-day moving average, that indicator looked like it was starting to turn down a few weeks ago, and now it started to reaccelerate on the upside. So all that to me suggests that the dollar stands a pretty good chance of breaking through to the upside here. So we'll take a look at that later on the stock charts platform, and I'm just going to move over now, and hopefully this comes up on your screen. You see that, Greg?
Ignition there, Mr. Pring. We have ignition. So.
We have, okay. So first chart here shows the Dow Jones Global Index. And what I've got here are three different rates of change: 9 months, 12 months, and 18 months. And the reason I put these three different rates of change up is because price at any one time is determined by the interaction of a lot of different time cycles. And when you're just looking at a 9-month rate of change or a 6-month rate of change, you're just looking at the time cycles close to that particular time span. So when you can look at lots of different rates of change of widely differing time spans, and they're all doing the same thing, they generally mean what they say. So in this case here, you could draw trend lines on the three rates of change, and you get a confirm with a trend line break in the index itself, and the bear market followed. And the same thing happened in the last cycle, pretty clear cut. So in the current situation, we have another of these setups, except this time it's not a decisive break below the trend line. It's come back to the trend line, so it's at a very critical point here. We also see that the index itself is right at its blue line, which is the 12-month moving average, and it's also at this extended bull market trend line as well. So just as this line represented support when the price was above it, now it reverses that role to one of resistance, as these lines down here do as well, because they've all been violated. So I think we're at a very critical point here, which suggests to me that probably and don't forget, with the market's been in a bear market, the global market's been in a bear market now for well over a year and a quarter. So this chart here again shows the Dow Jones World Index, and underneath got a 14-week RSI. And the pink shaded areas basically tell you when we're in a bear market. So we get a peak here and a trough there, get a pink shaded area. And the reason I put these pink shaded areas in indicating bear markets is because I want to see what's the behavior of the RSI during that period. And generally speaking, during a bear market, the RSI on this particular index has great difficulty moving above this 60 level here. Whereas in a bull market, it has no problem moving above 60, but every time there's the actual high of the previous bull market, and there was just basically one good rally during that bear market, and it failed to go through the 60 level. And the same thing during this little mini bear market there. You also see I've got three green arrows here, and the green arrows sort of are an indicator that the market is now no longer behaving as if it's in a bear market, but it's behaving like it's in a bull market. So in other words, when it crosses that 60 level threshold, that's when we get an arrow, and that was signaling the all clear from the bear market. Just one piece of evidence. It's not you wouldn't bet the mortgage on this particular study, but it is one important piece of evidence that the market is changing its character and going from bearish to bullish. And the same thing happened over here in 2009, I guess. And then once again, a little bit off the low here in 2016. I guess that was the end of 2016. We got another signal above the 60 level. Which brings us, excuse me, to the current situation where you can see that during the bear market we've had since January 2018, the indicator has been unable to move above that 60 level. Yeah, my view is that if I saw this move to 65, that would give me an indication that global markets were headed higher. Remember, on our US market, we had a stop barometer buy signal. Now we're looking at the world, which has been so far much weaker than the US. And of course, the US economy has been stronger than most countries around the world. So now we are moving to the US. This is the NYA. And underneath we have the special K, which is a momentum indicator that combines short-term momentum, intermediate momentum, and long-term momentum. So we get the big, broad swings of the long-term momentum, and then we get this jagged activity caused by the inclusion of short-term indicators, short-term momentum in the total. The idea is that about 70% of the time, the special K peaks and troughs with the actual market that it's following. And so we can see that with the benefit hindsight quite easily. There's the low here, and there's the low there, and there's the high there, and there's the high there, and so forth. So we have to figure out in real time whether or not the direction of the special K has changed. And that's done with two or three ways. One of them is to take this signal line here, which is a 100-day moving average of a 100-day moving average. And when it crosses below the signal line decisively, that's an indication that the trend of the momentum, the special K, is reversed. And another is because we've got this jagged stuff, it doesn't lend itself to short-term moving average crossovers too well, but it does lend itself to trendline construction. When the trend line is constructed and the signal line is crossed, you get two pieces of evidence and you get something confirming the price. You've got three pieces of evidence that the trend is reversed. So let's take a look and see where we are right now. First of all, as I mentioned before, we've already been in a bear market for the world for over a year. Started in January 2018, and now we're getting to April 2019. So that's one thing. The other thing is that the market is rallied up sharply and is now just below resistance in the form of these two converging trend lines. But getting back to the special K, it's possible to see, of course, that first of all, it violated this trend line, it violated its signal line. And now we got another trend line, a downtrend line we can draw. And look at the trend line is right in the same area as the signal line. So that represents, based on what we were saying before, a very important level of resistance, which the NYA needs to overcome if it's going to be signaling a bull market. And I think probably it will eventually. But what we may need to see is some corrective activity, taking it down towards the zero level. And then the next rally is the one we would watch out for a possible double bottom here, or a stronger foundation to allow prices to move higher. One reason I think that we will be testing the December low, but not necessarily going below it, is the 45-day rate of change here. And as you can see, it reached the blue line, 20% level, a couple of months, a month ago, I guess. And that's a very strong signal of powerful upside momentum. And you can see every time it crosses above or reverses from a level of 20 or higher, we get one of these green arrows. And most of them represent a period which is followed by a pretty strong market. Not necessarily immediately. Like this one here had a little drop just there before it started to move in earnest. But generally speaking, it's kind of signaled the end of the trend and the beginning of a new trend. There was one exception here, and that was in 2002 during the bear market, coming off the 9/11 low. So it's not a perfect indicator by any means, but if you're looking at the probabilities, most of the time this indicator works in in the sense that it's signaling the beginning of a powerful up move. So that's one reason why I don't think if we do see a test of the December low, I think it's probably going to hold. No guarantees on that one, of course, but it is definitely a positive factor. So let's move on, take a quick look at bonds here. Here's the 10-year yield. And it broke below this uptrend line here, going back to 2016, a couple of months ago or so, or the beginning of the year, and broke down from this broadening wedge. And a broadening wedge is kind of the opposite of a triangle. Where in a triangle, you've got your two boundaries are converging, and a broadening wedge, they're diverging, indicating as the pattern is being developed, there's more and more, greater and greater instability in between buyers and sellers. And typically, when you get a lot of instability building up, the next trend is an above average one. In this case here, it broke below the lower boundary of the broadening wedge. And so far it has been quite a nasty drop, or nice drop, I guess, in interest rates. Also, we're looking at the three KSTs, the short term, the intermediate, and the long term, as you can see from these labels, and they're all in a declining phase. So it seems likely that the bull market in bonds or bear market in yields is likely to continue. This chart here is an interesting one. It compares the 10-year yield in the upper panel to a ratio between the iBoxx high yield and the iShares 7 to 10-year treasury. In other words, when the ratio is rising, it means that investors are pumping more money into junk bonds because they're not concerned about the economy, and they don't go for the safety of the treasuries. And when it's falling, it means they're going for the safety of the treasuries and they're willing to overlook the high yield and the junk bonds. So as you can see, the ratio moves up and down fairly closely with the 10-year yield. And if you can see sometimes a joint trend line break in both, that gives you a pretty interesting signal that the prevailing trend of rates, in this case it was up, is now moving in the opposite direction on the downside. The other thing that the chart's useful, so if you go back to the front, back to the end of the chart, the right-hand part of the chart, you can see both series violated trend lines when just back in November, and that one and the yield violated the trend line in November. So right now it's in a bit of a downtrend because it's below its moving average. It's rallied up to the moving average, found resistance, and now it's moving in a negative direction, indicating bond investors are kind of losing confidence a little bit. And we've also got the long-term KST declining. Incidentally, there's another ratio that I follow, a similar thing where I compare government yields to corporate BAA yields. And we take the long-term KST of that, and that correlates very nicely with commodity prices. And it's doing the same thing this indicator is doing right now. It's currently in a bearish mode at around zero. So I think these credit spreads obviously in stock charts, it's pretty easy to put it together. One thing I would mention, this does not include interest or dividends. So you put the underscore sign in front of the two symbols. So anyway, it looks like it's headed to a test of this line here, and if it goes through, that will be good. On the other hand,
I was just going to say that, and just so you know, the HYG is only a couple of weeks away, literally mid-April of last year, of making a new 52-week high. So it's at 86.47, and that's the unadjusted. So you backed out the yield. It's at 86.47 now, and it's broken out to new, I'll call it 11.5-month highs. It wouldn't take anything to get through to new highs on the HYG chart. So
yeah, that's right. But this is a ratio of the two.
Yeah. So, anyway, it's quite interesting. Yeah.
Well, there's one other point I wanted to bring out, and that is the fact that sometimes you get divergences, and those divergences have been pretty reliable in the past. So in other words, we have the yield falling to a new low here, and the ratio does not fall to a new low, indicating that although bond yields are indicating a weaker economy here, confidence in the economy, as measured by this indicator, has not deteriorated to a new low, and that's a positive, and that's obviously a positive thing, which you would then need to see confirmed with a trend line break in the yield itself and so forth. But it is a positive sign that yields are no longer going down. And the same thing happens in reverse here, where the yield makes a new high and confidence is not as strong at that new high, and that's a prelude to the thing falling. Now, what I should have done, I don't know what happened here, but there was another divergence up here as the, no, there wasn't, I'm sorry. The reason I was showing you this was because the yield has made a new low and the ratio has gone up and it's now coming back down, but it hasn't made a new low yet. So it could be at a very interesting point. If this ratio comes down and hits the red line and then bounces, that will be a positive divergence. It would show that although people with the 10-year yield are losing confidence in the economy, the ratio between the high yield and the good quality bonds has not reached such a low level. So that's what we've got to watch. If it comes below this line, that would indicate the trend is down, and I'll agree with the long-term KST. But if it starts to reverse above this line, then you've got another positive divergence, just like you had just here. And then you will go to your trend indicators to see whether or not the yield was above its moving average and the ratio was above its moving average and so forth. So it's something well worth watching, I think. So here's the TLT 20-year trust, just broken out to the upside, obviously a pretty decisive break. And then you've got the special K. Again, we're using our trend line analysis and our signal line analysis, and it's just broken out of a 2-year, 2.25-year base here. So that suggests to me that while it may be a little overbought on the near term, bond prices are going significantly higher before they reach their peak. Now we're looking at the dollar, and here we have a monthly plot with a 12-month moving average and a long-term KST. The dollar is above its 12-month moving average. The KST is bullish. Therefore, the trend, objective measure of the trend as I see it for the dollar, is positive. And we saw on the other chart and the other platform that it was just below an important trading range marked by these two highs just here. So it hadn't gone through, but some of these supporting evidence, like the net new high indicator and the diffusion indicator, which, by the way, you can plot in stock charts, the dollar diffusion indicator, make it look like the dollar is moving higher. So here we see an indicator that moves in sympathy with the dollar. This is the SPY versus the Vanguard rest of the world. SPY versus the rest of the world. So it's S&P versus the rest of the world. So when it's rising, it means the US market outperforming the rest of the world. And when it's declining, it means the rest of the world is outperforming the US. But the reason I'm putting it up is because you've got a chart of the dollar at the bottom, and the two things are fairly closely matched. They certainly don't move tick by tick, but there is a close relationship between them. And this and the dollar as well is forming this consolidation pattern, as is the ratio between the dollar and between the S&P and the VEU. And I haven't shown you this, but the long-term KST of this ratio is also moving higher. So that kind of fits in also with that analysis where we were saying that the world index looks like it's running into resistance, going to have a problem where the momentum indicators are breaking below the trend lines, compared to the more bullish picture painted by the US market, where we have the stock barometer in a bullish mode. So this kind of is consistent with that, where the rest of the world may begin to underperform the dollar may be, the S&P might be in a process now to outperform the rest of the world. So we'll have to see how that pans out. Okay, that's the same ratio I showed you in the previous chart, and there is the long-term KST in a positive mode, like I mentioned. You can see the short-term KST for this relationship It's just starting to cross above its moving average. So get a little bit of strength next week, and you got a solid breakout there. So we want to talk a little bit about commodities, and so this chart here is a chart of the Canadian dollar against the CRB composite. And once again, you can see that, and I showed you this chart last month, that there's a pretty close relationship between fortunes of the Canadian dollar, a resource-based country, and the CRB composite. And it seems to me that if we could project a lower Canadian dollar or a higher Canadian dollar, that would be a nice piece of information we would have that would support whether we want to be bullish or bearish on commodity prices. So that's why I watch these two very closely, and that's very, very finely balanced, as it was last month. Look at the KST of the Canadian dollar. It's very, very, very finely balanced here. If anything, there's a slight downward bias because the CRB is broken below this little wedge here, and so has the Canadian dollar, but it's not decisively. You see the Canadian dollar just a little bit below its 12-month moving average, 74.96 versus 76.14. Is it not very far away here, about a point cent away. So it wouldn't take much to turn the Canadian dollar into a more bullish mode, because that would also push it into this trading range here. But at the moment, it's kind of a little bit iffy. Here's the Canadian dollar again, and you can see that it's held below this downtrend line and the moving average, which is a 200-day moving average. You can see the special K has done the same thing. So once again, it's not going to take a lot. That moving average is 75.81 for the Canadian dollar to break to the upside. But right now, as we see it, you have to say it's in a bear trend. I'm now going to switch to the British pound here, because I thought it's kind of interesting. This is a long-term chart of the British pound going back to 1990, and you can see that it broke down below this very important red support line. And it had its initial post-Brexit rally. It rallied back to that line again, and then found some problems. In the last week, it's gone back below its 12-month moving average again, and the KST is, you can't see it here, but it's still bearish, but very, very slightly so. So it's in a very fine state of technical balance here. And then we look at this daily chart, and it becomes really interesting, because it looked like the pound was thumbing its nose at the mess of the Brexit situation and was forming a base and was going to go higher, and it did. And then it bounced back, came back down to its moving average, 200-day moving average, and then made another attempt at breaking above this resistance and failed. And now it's come back to the same level it went to before. It's gone back to this trend line and just a little bit above its 200-day moving average. So usually when you get a false breakout of this nature, you get an above average move in the opposite direction, because a lot of people position themselves on the breakout, and when that breakout fails to materialize, they're then forced to make a decision of whether they're going to hold that particular item or liquidate it. So if the pound drops below this uptrend line here, I would expect to see a nasty decline take place. And also you can look at the KST here, which made lower highs, I should say, as the currency itself was making higher highs. So I think the pound is something you want to watch next week, because we may see some fireworks now. Now I'm going to.
Yeah, Martin, and we've got about 3 or 4 minutes left. So.
Yeah. Okay. I was gonna switch to these charts on the Chinese market. Sorry, Greg. Okay. So here's the Shanghai composite, and it broke below its secular bull market trend line, and it looked pretty bad a few weeks ago. And now it's pulled back above the line again, and now it's finding itself at resistance at this downtrend line going back to 2015. So it's at a critical point. And one of the points I wanted to make was that the ROC, the 18-month ROC, going all the way up 10 years back, it's just below that trend line, and just as the price itself is just below the trend line. You can see what happened when this trend line here in 1997, 2006, it's a 9-year trend line. When that got violated, we had a pretty explosive rise from that huge, huge bull market. So what I'm saying is that Chinese equities, because they've broken below here on a whipsaw basis, suggests to me that the market's going much higher. What I need is some confirmation from a break above this line here and this line here, and then I think we're off to the races. To give you an idea of a break in trend line, we had this one here. This is gold, and this is 1981 to 2000, 19 years. Break in the rate of change trend line, and that was followed by, of course, that secular rally in gold. So what we're seeing in the Chinese market is really quite fascinating, I think. So I got to wrap it up there, Greg. I'm sorry I didn't leave too much time for discussion here, but
we have a few minutes. And Martin, on the so one of the things that's interesting is in France, with all of the red vest protests, that's probably the strongest chart in Europe right now. The rest of the countries are all below their 20-month moving average and moving down. But Asia's starting to improve, with the exception of South Korea. The Nikkei is still below its 20-month. What's your big picture on the countries, I'll call it, other than China?
Well, I was looking at a really interesting chart on Japan on the Nikkei and last week. And it has an 84-month rate of change, which kind of like, what's that, 7-year rate of change. And that rate of change has peaked from a pretty high level, and it's happened 4 times in the past that it's done that. And on 3 of those occasions, it was followed by a nasty decline. And also the rate of change broke an uptrend line. So to me, Japan looks a little bit iffy. It needs to cross below its I think it was a 48-month moving average, which is at 19,800. I think the index itself is around 20,000, 21,000.
21,000, yep. 20.
Yeah, so you have to fall a little bit, and it would cross that 48-month moving average, where there's also an important trend line. So to me, that's an interesting juncture. It hasn't broken yet, but it's looking a little iffy.
Yeah, I feel like I
don't see a lot that I can get very excited about when I move around the world. We have this monthly publication, Intermarket Review, and if I'm ever able to, I always recommend some foreign ETFs. And I can't really find anything outside of China that looks interesting at this point.
Well, and I think the breakout in the US dollar usually pushes the rest of the world lower. Not always, but for the most part, emerging markets for sure follow commodities closer than they follow. So a strong US dollar would push them down. So I know I can't help but say it feels to me like we're standing on the edge of the cliff, and whether we get to fly or fall, I haven't figured out. So anyway, Martin, we should probably wrap it up here. We're getting towards the end of the broadcast. Thanks for taking the time to show us those charts. Always such good ones to look at, and I hope to use a few of those in my presentations this week. So thanks again for sharing those with us.
Thanks for hosting, Greg.
Okay, and just so everybody knows that Martin's Intermarket Review, if you go to pring.com, he's published it for 35 years running, and you'd be able to look at that, but it's about a 60-page document he publishes once a month. It's quite fascinating. Anyway, thanks for taking the time, Martin. Everybody, wishing you a great April, and we'll catch you next month with Martin's Monthly Market Review. Thanks. Bye-bye.